the primary thing that I want you to be able to walk away from today's session and this trading summit is, what are the techniques to position sizing that can lead to profitability? A lot of traders think of profitability as, learning technical analysis, learning option strategies, getting access to real-time data. I promise you, those things are all important, but they're not the reason as to what determines between whether a profitable trader or an unprofitable trader. What you're going to learn today is what is going to drive the difference between successful traders and everyone else. There's the loss side and the winning side. But it's one thing to say, here's how you do to manage your losses, here's what you do to manage your winners. What's not said many times is the emotions that you're going to have to go through to implement those two strategies. So last week we talked about never risking more than 2% of your total account of total capital per trade. We went through the math behind that, why that is such a hard and fast rule, and there's no give on that. There's no, maybe sometimes you can go a little bit more, sometimes you go a little less. It's hard and fast 2% rule, because consecutive losses happen far more often than you happen, and the gains that are required to break even grow exponentially. If you get to a certain size in terms of loss, your gain to get back is so astronomically high, your chances of getting back are virtually zero. So you must make sure that you keep your losses small. The second part, adjusting small winners into potentially home runs. This is what we're going to talk about today. But basically, once you have a trade that's a winner, instead of taking profits, you actually add more exposure. You're basically hoping that what the trade that you've confirmed is correct will continue to be correct, and you can turn small wins into home runs. And when you balance cutting your losses small, keeping your losses small, and potentially hitting home runs, that's when you start to reach profitability in the long run. So again, conceptually, not that difficult to understand. What is the difficult part is the implementation of that, because it requires you to face some really uncomfortable trading decisions. And it also requires you to understand, what does it mean when you keep your losses small? And what does it mean to try to hit home runs in the perspective of your day-to-day? Because that's really kind of the part that probably most traders don't talk about. And this is also the reason why you might be following someone else who's a successful trader who says, can maybe even show you a valid track record and said, look, here are my trades. If you look at my trades, I've been profitable the last 10 years. If you just follow me, you'll also be profitable. Why does that process never work? Because you don't understand the emotional decisions that they have to make the trades that resulted in those profitable trades. If you were to be in those same shoes and you had to make those trades, you may not follow that person saying, cut this loss. You might say, you know what? I'm going to hang on to this for a little longer because I don't want to accept this loss. I'm going to hopefully, because I think you're wrong, I think this might come back. Or if someone tells you to not take profits and you're going to say, hey, this is already a winning position, I'm going to take some profits now. That's what contributes to underperformance in the long run, because the true process for gaining profitability is actually you have a lot of small losing positions. What that means is that you're actually going to have more losing positions many times than winning positions. That sounds counter to profitability, but that's actually how you keep your losses small. When something doesn't work out, you cut those losses ruthlessly, and what that results in is actually more losers. And then when you have a small win, you try to hit some home runs with that small win. Guess what? Those don't pan out all the time. They only pan out a handful of the times, maybe even only half the time you actually do that. So what that means is that the number of winners that you have is actually substantially lower than the number of losers that you have. And that's a pretty uncomfortable position for a lot of traders to be in, to stick day in and day out, feel that, hey, I keep having more and more losers and I have very, very few winners. But it's not about how many wins and how many losses you have. It's about the size of the wins versus the size of the losses. And that's really a hard thing to grasp, to put your head around. And the second thing that makes it even worse is that sometimes to do this, to hit home runs, you turn what is a small win back into a loss, right? So you really have this uphill battle, or what feels like an uphill battle, where it's just a constant stream of small losers you've got some small wins that somehow turn back into losers. And then once in a while, you hit these big home runs. It's not an easy process to deal with, to kind of go through that. But you have to understand that that's the process, because if you don't understand that process, you're going to get disheartened. You're going to come across a string of losers and you're going to say, this is not for me. I'm going to go back to doing what I used to be doing. I want to have more wins than losses. But that is how you slide back into your old behaviors and go back to being, the behaviors that contribute to underperformance. Now, the question that I always get is, are these sessions recorded and can I get the slides? And the answer is absolutely. You absolutely should watch the recordings, because this is especially the type of topic that you can't just absorb in just the 45-minute session. It takes time to review and learn before you can really implement the things that you're going to learn here today. So all of our recordings are available if you're a member here at OptionsPlay. And I really want to thank the members for supporting us and allowing us to continue to do this. Now, if you don't have an OptionsPlay membership, you can still get access to the recordings by signing up for a free trial at optionsplay.com/grow. For those of you that want to sign up real quick right now, it takes about 10 seconds to sign up. Point your phone to that QR code and do it quickly on your phone, because this way you'll get access to not only today's recordings, but you'll also get access to the first 2 sessions. Like I said, this is a 3-part series. Important for you to get all 3 parts. So not only you get the recordings from today and the slides, but you'll also get it for the first 2 sessions. You'll also get access to all the tools and the daily play trading signals, which is how we show you how we implement these rules day in and day out through the trading signals and the trade ideas that we show you. Because it's one thing to see it or understand it from a concept. It's another thing to see it in action every single day. And that's what we do with our daily play process. And you get access to all of that either by a membership of OptionsPlay or by signing up for a free 30-day trial, and you'll get access to all of that. So this is really the part that I think a lot of successful traders never talk about, is the emotional decisions and the hardships that you go through to reach profitability. And even for many of you watching this today, you might understand my words. You might even say that I agree with you or I understand. But when it comes to the actual process of doing it, you will find it difficult and you will likely revert back to your old behaviors. But this is what I mean by it's a continuous process. This is not a one and done deal. This requires time and time consistency to face these things that are uncomfortable and keep making uncomfortable decisions effectively in order to get to that point of profitability. And that's why relatively few traders reach that point. It's because, one, they might not even know that this type of process exists. So I mean, imagine trying to do this when you don't even understand what to do. And second of all, even when you understand what to do, it's a difficult thing to follow through with. That is why so few traders succeed in trading. But that's why I think this is such an important lesson. This is why I spent a whole month teaching this session, so that you can understand what it takes to get to that path of profitability. Okay? So, just a reminder, the daily play trading signals, for those of you that are members or currently on a free trial, you get every single day signals from us to decide when to get in and when to get out of a trade. This is my attempt at showing you how to implement what I'm teaching you through this trading summit every single day. It's a reminder every single morning how to look at your open positions, which ones you might want to cut losses on, which ones you want to add exposure to as they're working in your favor, and how to think about that process. We try to do that for you every single day in the daily play. So for those of you that are currently members, you know what I'm talking about. I try to elaborate as much as possible into what I'm thinking, how I'm trying to approach our current open positions and managing them, adjusting them. And you'll notice, losers, we cut them very quickly. When the market says you're wrong, you don't think about it anymore. You say, I'm wrong, keep those losses small. When the market confirms that I'm right, that's an opportunity to hit home runs. We recently did it on JPM. We recently did it on Hilton. We have another one on Whirlpool right now that's working out that we are going to add to. T-Mobile reports this afternoon. I actually don't know what their earnings look like, but that was another one that we added exposure to as the market proved that we were right. Hopefully that turns into a home run. But guess what? It's possible that that small winner goes back into a loss. But unless I'm able to hit home runs, I'm not able to offset my small losses. So that's how it's so important for you to follow all three things in order to be profitable. You need to start small in terms of risk, make sure you cut those losses very quickly, and then you add to winners. And that's what I show you how to do every single day through our daily play trading signals. So let's now talk about adjusting winners. This is where most traders don't spend enough time and their energy on. I tend to find that most traders that struggle with consistency spend all their time trying to adjust losers. Probably the number one question that I get as a market strategist is, it's some variation of this question, is I got into a trade, it didn't work out. What can I do to adjust this to try to turn my losing trade back into a winner? But I'll tell you, even if you are able to successfully turn your small loser back into a winner, that's not how you get ahead. And by doing so, you likely can turn a losing position into a bigger winner. Yet we spend all this time, when I look at traders, I tend to find that traders will spend 80-90% of their energy focused on these types of scenarios. They have a losing position and they're thinking, how do I turn it back into a winner? But what I always tell those traders is that you're focusing on the wrong thing. If the market has told you that you're wrong, stop trying to fix it. And something I spoke about in the first session, I understand why you want to fix it, right? Because in all other aspects of your life, when something goes wrong, what do? You take action to fix it. But you can't fix a losing trade because you can't control the market and you can't tell the future. Those are the two fallacies that we have when we try to adjust our losing positions. It is we're basically trying to say, something has gone wrong, I can go and fix it. Because in your personal life, in your professional life, when something goes wrong, you go and fix it. That's the mark of someone who's active, who's proactive, who wants to do something. So a lot of times it's actually the smartest traders that focus all of their energy on this process that actually contribute to underperformance. What you should be doing is cutting your losers. Don't think about it. But when the trade works in your favor, when the market is confirmed that your view is right, that's your opportunity. That's your opportunity to turn the small win into a home run. How do you do that? When the market confirms that your outlook is correct, instead of taking profits, you add more exposure. Basically, you took a small bet that that something is going to move in one particular direction. When that turns out to be correct, you might be onto something. Try to ride that trend. Try to see if that continues. And if that continues and you add more exposure, you can turn what is a small win into a much, much larger win. Does that make sense, everyone? Please type 5 into the chat window if that makes sense to you. This is the most important element to understand from today's session of this concept of when the market proves that you're right, that's not an opportunity to take profit. That's an opportunity to add exposure. And that's an incredibly painful process to go through because by adding exposure, you're increasing potential that this small win turns back into a loser. And that is something that a lot of people don't want to do, but that is the key that will that's the counterproductive or counterintuitive decisions that you have to make if you want to succeed in trading. So what you're doing here is you're giving the winning trade the opportunity to continue to hit that potential home run. And this does, like I said, risk that small win turning back into a break even or even a loss. But small losses is not what contributes to underperformance. Big losses is what contributes to underperformance. And you can keep your losses small. As long as you keep your losses small, you can once in a while hit home runs. That's the equation to being profitable in the long run. So the difficult part of all of this is that adjusting a winning trade is very much an art, less of a science, meaning there's a lot of different ways to do it. There's a lot of different points at which you do it. There's a lot of degrees as to how far you go with that concept. But this is really where you have a lot of flexibility and something that you have more control over. And when you spend 80-90% of your energy on this part of the equation, that's really when you're going to see leaps and bounds of gains in your trading versus adjusting your losing positions. And many of you can probably relate to this, where you've seen how do you adjust a losing position back into a winning position? And yet, despite those things, do you feel more confident? Do you feel more consistent in your trading? And I can almost guarantee that that does not happen, because I've seen it over the past 17 years of people trying to do it. So let's talk about adjustments. So before we talk about how to adjust, let's talk about when to adjust. Now, there are generally three, I would say, primary criteria for adjusting, but there's perhaps more that you can maybe think of, but three that I can generally consider as to when you might want to adjust. First is a breakout or breakdown. So imagine that you have a stock that's trading in a trading range. You think it's going to break out. What you basically do is you perhaps enter a position prior to breakout, like we did with Hilton, what we did with JPM, what we did with Whirlpool. We basically said, we think that, there's a catalyst coming up that could drive the stock above a resistance level, and that is the potential start of a much larger trend, right? This is a pretty common strategy from a technical perspective. So what you do is you enter the trade here prior to the breakout. Once you get the confirmation that the stock has broken out, that's your opportunity to now add more to that position to hope that this will continue moving higher. Does that make sense? Multiple closes above or below an important level if it's a breakdown, where you expected something to break and it did break above or below that level. That's a good time to potentially add further exposure, because the market has confirmed your view of that breakout or breakdown. Second thing is a trend change. What I mean by that is that almost all technical and indicator-based signals, so whether you're using MACD or RSI or stochastics, those oscillators, those momentum indicators are all trying to measure a change in momentum or change in trend, right? So if, let's say, you have RSI that is, dip below 30, and now it's kind of come back up above 30, that's your buy signal. What you're basically saying is that a stock that has trended lower is now going to reverse higher, right? That, in very simple terms, all momentum indicators are telling you is a change in trend. Whether you use, a price action, whether you use momentum indicators, you're all trying to see whether a stock is turned from bearish to bullish or from bullish to bearish, right? Those are kind of the starts of opportunities. So whenever there is sufficient evidence that the trend change that you expected to has solidified and has started, that's another opportunity to add to that position. So if you have an RSI reading that crossed above 30, you bought the stock, and now you see the stock move higher as a result of that, meaning it hasn't continued to move lower or move sideways, that's an opportunity to add to it, because you've been basically confirmed that the trend change has happened. Now let's see if that trend continues, and if it does, that's your opportunity to hit a home run. Third of all, if, let's say, you're just trading a trend, a stock is trending higher, what you want to do is potentially wait for pullbacks in that trend to add exposure, so that if it continues in that trend, because trends never move in one straight shot, they tend to move in waves. What you basically want to wait for are pullbacks in a primary trend to add further exposure. Those are the generally three types of conditions that you'll come across where you might want to consider adding further exposure rather than taking profit. Does that make sense? Please type 6 into the chat window if that makes sense. Perfect. Let's see. Let's now talk about adjustment types, right? So we talked about when to adjust. Let's now talk about how to adjust. So I'm going to start with the simplest one, and that's the one that I use for the daily play trades, because it's really, really simple to understand. Everything else that I'm going to talk about here today is sort of a variation on that, or some sort of variation on something that has been used in the past. But, from my perspective, I like to keep things simple, and I'll start off with the simplest adjustment, which is simply using a fixed percentage of the total capital in your account. So we use a fixed percentage when we enter a trade, right? So every single time we enter a trade, we risk 2% of our total portfolio value. And in a daily play account, we trade a hypothetical $100,000 portfolio. So every time I enter a trade, I show you how I calculate the number of contracts on that $100,000 portfolio, so that you can see how many contracts we're trading, and you can adjust it to your portfolio size. So if you have a $50,000 portfolio, you trade half as much. You have a $200,000 portfolio, you can trade twice as much. But because we use a fixed percentage every time we enter the trade, every time we adjust the trade, we also adjust it based on the same fixed percentage. So what that means is that, for example, in that JP Morgan trade, when JP Morgan was trading sideways and we were looking for that breakout, we added 2% of our total portfolio value, hoping to bet for that breakout. And when the breakout happened, we added another 2% to that particular trade. So basically, we risked $2,000 in the first trade, and when we added to that trade, we added another $2,000 worth of exposure. So now what we basically have is 4% of our total account value at risk on this particular trade. But remember, because the trade has gone in our favor, we've got this buffer, we've got profits to play with. So we're not truly risking the same $4,000 as the same, because especially when we move our stops up, and that's something I also talk about in our daily plays, is that as we add exposure to a trade, we typically will move our stops so that the total risk that we're taking is very similar to the initial trade. But because we have doubled the exposure, if the stock continues to move, we make it double the profits to the upside. And sometimes, in rare occasions, we might even add another 2% if it continues to move higher here. So, it's not often that you get to add that third time, but occasionally you do get to add that third time. And this is really where at that point, you've gotten enough profits from the first two positions where by the time you raise your stops, you probably are either at break even or even above break even, and you have now tripled the exposure to the upside. So if it really continues to rip, you have that chance to hit a really, really massive home run. Doesn't happen very often, but that's kind of how a fixed percentage adjustment works. And that's the one that we use for the daily play because it's so simple and easy to understand. The second one, which is very similar to it, is a fixed dollar amount. Now, this depends on whether the value of your account fluctuates heavily. Smaller accounts, tend to have percentages fluctuate a little bit more heavily. Let's say you're working with a $10,000 account. One day, 2% might be, $200, and the next day 2% might be $300. Next day it might be $150. It fluctuates a lot. So in that particular case, you might want to use a dollar-based amount each time. So let's say you commit $200 worth of capital on the first tranche. As the trade works out, you add another $200, another $200. So this way, you are keeping kind of the trades more consistent, even though the value of your account may be fluctuating a little bit more because you have a small dollar amount. The third strategy is pyramiding. This is basically you adding, let's say, 2% initially when you first get into the trade. As the trade goes in your favor, you might add 1% and then a further maybe 0.5%. So you're basically going up or down a particular pyramid. Now, there are some traders that will go down the pyramid, and there are some traders that will go up the pyramid. Maybe they'll start their trade with 1%, then they'll add to 2%, and then as the trade moves further, they may go up to 3%. There's no hard and fast rule as to what's going to work. And you're always going to find certain scenarios where going, pyramiding works, anti-pyramiding works better in other scenarios. And this is really why I tend to prefer a more simpler method, just a fixed percentage amount every single time. It's much easier to manage, much easier to kind of mentally kind of keep track of everything as well. So, but, these are all variations that are reasonable, and each are ones that plenty of successful traders have implemented for their trading. So when you spend 80 to 90% of your energy focusing on adjusting winners, you have a lot more time and effort to kind of play around with these ideas and different techniques that can contribute to gains in your portfolio. Another one is called the Martingale System, and this is probably more commonly known amongst gamblers, where you either double the trade size after a win or you double your trade size after a loss. So what that means is that let's say you have 2% of a trade. As the trade goes in your favor, you start to add to it. You do 4%. As it goes into favor, you add 8%. Not a big fan of the Martingale system. There are lots of books on the Martingale system. There are lots and lots of literature written on the Martingale system. And predominantly all comes down to one thing: is that it's strategy that is incredibly powerful, but the risk of ruin or the risk of blowing up your entire account is incredibly high. So there are what we call modified Martingale systems where they basically say, you start at 2% and by the time you get to 8%, you never double beyond that to try to prevent kind of when you get to just a ridiculous size. So there's all types of variations. There's tons and tons of literature if you want to read on Martingale systems as to, either you double your size after every single win or you double your size after every loss. And there's pros and cons to each one. So do a little bit of research and find which one kind of resonates with you and one that you think makes sense. You can also have a volatility-based approach, basically adjusting your position size based on the underlying volatility. Basically, as things get more volatile, you might trade a smaller size. As things get less volatile, you might trade a larger size, or vice versa. You might want to trade more size when there's more volatility and less size when there's less volatility. Up to you. This is what I mean in terms of this is more of an art than a science. And you can really do any variation of the ones above, right? You can start with a fixed percentage and then do a fixed dollar amount after each individual tranche, or vice versa. You can adjust any of these. You can use combinations of these. There's no right or wrong. It really comes down to what you're most comfortable with and what you feel works for you. And what works for me is the fixed percentage, just because of how simple it is. And I recommend that if this is your first time doing it, you start with something simple that you can understand, that you don't have to do any math behind it to figure out. And once you get comfortable with it, you can then start playing around with some of the variations to help see if they improve your results. Because it also depends on the type of trading that you do, the type of signals that you're using for your trading account, as to which one of these might work better for you. Like I said, I think a good all-rounder, a good simple one to understand is either fixed percentage or fixed dollar amount as a starting point. All right. So, path to growing consistently. Balance out your education. That's the one thing that I hope that you take away from this, is that, many of you that are here have spent a lot of time on technical analysis, on option strategies, on different techniques and strategies for trading. You've probably spent money on indicators. You've probably spent money on subscriptions. And if you've done all of that and still find yourself inconsistent in your trading and not confident in your ability to grow your account, it may not be who you're following, what indicators you're using, how much technical analysis you know, how knowledgeable you are in options. Because I will tell you, those are not the keys to success in terms of trading. It's what I've taught you here today. Understanding what what behaviors you have as a result of the emotional, what's the right word? The emotional journey that you go on as traders, as you go through wins and you go through losses, right? And how to handle those scenarios, because the way that you do handle them versus the ways that you should handle them are almost polar opposites, right? As humans, we kind of do the exact opposite of what we should be doing, especially when it comes to money sometimes. So balance out your education by taking time and effort to understand what I taught you over the past few sessions, because this is arguably more important than anything else in terms of contributing to your ability to succeed in terms of trading. Successful traders are not focused on teaching, unfortunately, and professionals, unfortunately, have very little incentive many times to teach this. Understand emotions of these strategies. The concepts are incredibly easy to understand. It's very difficult to implement it because it's hard to teach the emotional element of it. I can only help you understand what you're going through, what you're feeling, and how you should be dealing with it, but you have to go and deal with it yourself. You need to take time to reflect on your feelings and your behaviors when you're doing this. So, as I write in the daily plays, time to cut your losses or time to add to these winning positions, ask yourself, what do I feel when I go and do those things, right? When I go take that loss, what am I feeling, right? Do I feel this feels terrible? You know what? I don't want to do this. I'm actually gonna hang on to this, hoping that it'll come back. And when I tell you to add to a winning position, do you actually go out and do it? Do you feel good about it, or do you feel that you're putting a win loss of turning back into a loser? Understanding how you're feeling and writing it down sometimes is more important than all the technical analysis and options trading you can possibly have in your training. So hopefully this helps put you onto your path of profitability and consistency in your trading. With that, that covers what I have time to share with you here today. Thank you once again so much for your time. I really hope that this was helpful in giving you a better understanding as to how you can put yourself onto that path of profitability. For those of you that have not signed up yet for OptionsPlay, free trial using that link here on your screen or that QR code. Take the time, watch the recordings, go through for all 3 sessions, take the time to review them, start journaling, start writing down kind of your thoughts and emotions as you go through these trading decisions, and you'll start to see patterns emerge, and you'll start to have the ability to correct yourself from these behaviors that contribute to underperformance and put yourself onto that path of profitability.